It starts with the Supplementary Financing Program, SFP. And you know that anything that's got a government name like that has got to be bad news, and this is no different. Going back to 2009, when quantitative easing started, the objective of the Fed was to bring down interest rates at the long end of the yield curve. So they printed funny money out of nowhere, went into the bond market, and bought the long end of the yield curve. That creates more demand for those bonds, bringing interest rates down. It's very important that you understand how this works in practice. We're going to be connecting the dots in steps 2 and 3. The Fed buys these treasuries from the primary dealers or the banks under their umbrella. Those treasuries go to the Fed's balance sheet. To pay for these treasuries, the Fed simply credits the reserve accounts that these banks have with the Fed. So that money goes into their reserve accounts. That increases the level of reserves in the system. The problem with that is that could create too many reserves in the system. In the beginning, the Fed was most likely worried about inflation because the reserve accounts of these dealer banks were getting so high with the Fed because of their asset purchases. That would potentially create inflation if that money got into the real economy. That would defeat the purpose of quantitative easing because remember, their goal is to bring down interest rates. Well, if they created inflation, that would push interest rates back up. So then the question becomes, how do you continue to print up all this funny money without it going into the reserve accounts of the actual banks? Insert the SFP. To figure out the details of how this worked, let's go straight to an online article. The Treasury Supplemental Financing Program was introduced in the fall of 2008 to assist the Fed in its massive operations to prop up the financial system. The SFP represents an alternative device by which the Fed could reabsorb the reserves it created. Essentially, the Treasury borrows on behalf of the Federal Reserve and simply holds the funds in the Treasury's account with the Fed. When a bank delivers the funds to the Treasury for purchase of the T-bills sold through the SFP, those reserve deposits move from the bank's accounts with the Fed to the Treasury's account with the Fed, where they now simply sit idle. So basically the SFP was kind of a wink and nod deal. The Fed went to the Treasury and said, listen guys, we've got this little problem. We printed up about 500 billion, maybe 600 billion, and it's in the account of all these banks and we need it out of there ASAP. If you could do us a big favor and issue all of these T-bills into the market, because we know those banks are required to buy those T-bills from you. And if they buy those T-bills from you, that means the reserves will go from their account down to your account, which is called the Treasury General Account, and then it will be out of the system. Problem solved. And you may be asking yourself, well, George, okay, but it doesn't seem like that big of a deal. Really, editor, throw up a chart of the TGA really quick. Prior to the SFP, the Treasury General Account rarely had over $5 or $6 billion in it. After the SFP, that jumped up to over $100 billion. And then after 2016, it got incredibly volatile, going all the way up to over $400 billion at one point, crashing down to under $50 billion. This is extremely important that you remember this volatility and associate it with the 2016 date when it started. What the Fed didn't realize is they had done a deal with the devil, and you will realize exactly why at the end of this video. Step number 2, the devil and the repo market. What happened is the Treasury realized that, aha, I see what happens. As the reserves of the banks go down, our reserves go up, and vice versa. And it doesn't just happen when they sell T-bills. It also happens when they collect taxes, as an example. So you've got the real economy. and the real economy has to pay their tax, and they all have bank accounts with bank A, B, and C, which keep their reserves at the Federal Reserve in these reserve accounts. So if the people have to pay their taxes to the Treasury, or the devil, and that Treasury deposits that money in their TGA, the Treasury General Account, that money comes directly from the reserve accounts of the banks. So as the people in the real economy pay their taxes, if the Treasury doesn't spend that money right away, that makes the reserves in the bank accounts go down and their reserves go up. And it works in reverse order once they start spending money. The Treasury takes these reserves from their account and spends it into the real economy. Then the real economy deposits that money back into the reserve accounts with the banks. Now you may be asking yourself, okay, George, I get it, but what's the big deal? Why does that pertain to the repo market? Because the more reserves that are in the system with the banks, the more money that they have to lend into the repo market. In other words, the more money that the Treasury General Account has, the less money there is for the repo market, and the less money that the Treasury General Account has, the more money there is for the repo market. Step number 3, the devil realizes the correlation between the repo market and the stock market. As the Treasury General Account goes down, that means they're spending money into the real economy, as an example. The people in the real economy take that money, they deposit it with their banks, so the reserve accounts of these banks go up at the Federal Reserve. The more reserves that are in the system, the more money they have to put into the repo market. Insert the hedge funds. They come in with whatever collateral they have, treasuries, maybe it's mortgage-backed securities, and they offer that up into the repo market. The banks take these reserves, they give them to the hedge funds. The hedge funds take those reserves and put them into the stock market, buying anything that's not bolted down into what is now basically just a casino. To understand how this works even better, let's go to a recent interview with Real Vision's Raoul Pal and Dr. Barton Wang.
So when the repo market goes askew, what you're picking up in the equity markets is when there's enough liquidity or reductions of liquidity, you're seeing the amount of leverage that, let's say, the hedge fund system or the leverage players can take increases and decreases. So trades get taken off, trades get put on because of what they're able to do in the funding markets.
I don't think hedge funds are sitting around waiting to see what that liquidity is doing. I think people are leveraging up because of the existence of these liquidity. So that's definitely fueled the equity market rally. And it's a positive feedback too. The more it rallies, more people want to.
It's kind of Pavlovian as well in how it operates. And, you know, even if it doesn't actually have even if it's a placebo effect, it still works.
That's true, yeah.
The Treasury now has a tremendous amount of control over the amount of reserves in the entire system. Because their account has grown so large, they've got a massive amount of power. They can even do their own round of quantitative easing. All they have to do is sell down maybe 100 billion, 200 billion from their account. That goes into the reserve accounts of the banks. That provides the additional liquidity for the repo market. Hedge funds lever up, stock market goes to all-time highs. Also, it gives them control over the Fed in the sense they can force the Fed to print money whenever they want. And if you don't believe me, let's go back to that chart of the Treasury General Account going back to August 2019 to September, the middle of September 2019. Well, we know that repo rates at that time spiked up to 10%. They went through the roof. What happened to the account that the Treasury has? It went up by over $190 billion. Well, if the TGA account goes up by $190 billion, that means the reserves get depleted by $190 billion. That means less money for the repo market. The repo rates spike. The Fed is forced to come in, inject liquidity by doing what? Printing money. Oh, time out. I got a question for everybody. We know that the Treasury played a direct role in making repo rates spike. in the middle of September, which forced the Fed to come in and print money. So my question to you is, did they do it on purpose? It gave them a lot of control over the Federal Reserve. Why don't you let me know what you think in the comments below? Now, let's get back to the video. You see now why I said earlier in this video that the Fed didn't realize it at the time, but they did a deal with the devil. The Treasury has weaponized the TGA, and they can use it to control the Fed, to control the stock market, and potentially control the outcome of the 2020 election. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.